What if the biggest warning you'll ever receive is happening right now, quietly, subtly, almost in whispers, and you don't even realize it? In March 2025, a series of small but powerful signals begins rippling across the global economy, signals so understated that most people overlook them, yet so serious that those who understand their meaning are already moving into position. A leading solar manufacturer in Germany suddenly cancels all upcoming orders, offering no explanation, just silence. In Virginia, a major defense contractor quietly adds silver to its strategic reserves, something they haven't done in decades. Across Asia, 3 of the largest refineries unexpectedly stop accepting new contracts altogether, an unprecedented freeze. And in London, the oldest bullion dealer on Earth imposes strict purchase limits for the first time in its 340-year existence. These aren't theories. They aren't future scenarios. They are happening right now in real time. Individually, these events look like anomalies, but together they paint a picture that's impossible to ignore, a picture that suggests global industry is bracing for a supply shock unlike anything we've seen in decades. If this pattern continues, the world may be standing at the edge of the largest industrial commodity crisis of the 21st century. And most people won't see it coming until it's too late. Over the next few minutes, it becomes important to understand a familiar pattern, one that has appeared before every major resource crisis in modern history. This pattern moves through 3 stages: strategic stockpiling, export restrictions, and price controls. We saw this play out during the oil shock of 1973, again during China's rare earth restriction in 2010, and once more in the semiconductor shortage of 2021. Now the same signals are appearing in the silver market. But this time, the situation is far more serious, because unlike oil or semiconductors, silver has no real substitute and no new technology waiting to replace it. When supply tightens, industries cannot simply adapt. They slow down. Some even stop. The first stage of this pattern is what experts often call silent accumulation, though nothing about it is truly silent once you know what to look for. This is the phase where governments and major corporations begin quietly stockpiling a resource without making any public announcements. There are no press releases, no warnings, and no price spikes, just steady, deliberate buying that drains the global supply without anyone noticing until it is too late. Several countries have already moved into this phase. China stopped reporting its silver import data in late 2023. That may sound small, but it is a major signal. When a nation that consumes roughly 1/5 of the world's annual silver supply suddenly stops sharing its numbers, it usually means they do not want the world to see how much they are acquiring. Transparency disappears when accumulation begins. India has taken a different approach, but with the same underlying message. In 2024, the country imported more silver than it had in nearly 4 decades. These imports were not for jewelry or consumer goods. They were directed toward national reserves. The Indian government even reclassified precious metals, placing them in the same category as military-related assets. This is not something countries do for ordinary industrial materials. It is something they do for resources they consider strategically important or potentially weaponizable in times of crisis. Russia has moved even more aggressively. In early 2024, it diverted every ounce of domestic silver production into state reserves. Nothing was sold on the open market. Nothing was exported. Everything was stored. When a major producer stops sending its supply into global circulation, it creates an immediate and powerful pressure on the rest of the system. And then there is the United States, a country that once led the world in financial strategy and resource planning. Today, it has no strategic silver reserve, not a partial reserve, not a shrinking reserve, zero. The last of it was sold off between 2005 and 2015, while China, Russia, and India spent years building physical control over their silver. The U.S. chose a different path. It relied on financial instruments, paper markets, and the belief that supply would always be available somewhere in the world. Now that belief is being tested. Corporate behavior confirms this shift as well. Tesla, one of the largest technology and manufacturing companies in the world, locked in 7-year silver supply contracts in 2024 at fixed prices. Companies do not secure long-term deals like this unless they expect future shortages or rising costs. Moves like this are not driven by optimism. They are driven by caution. Taken together, these developments tell a clear and urgent story. Governments are stockpiling. Corporations are locking in supply years in advance. Key data is being hidden. And major players are acting as if the world is entering a new phase, one where access to physical silver becomes more difficult, more competitive, and eventually more expensive. The early signs of crisis have already begun. The only question now is who understands what they mean, and who will react before the rest of the world wakes up to the reality of the situation. When the largest companies in the world start securing silver years in advance, it isn't a coincidence, it's a warning. Tesla locked in long-term supply before any public signs of shortage. First Solar did the same. Then Panasonic, LG, and Samsung followed, bypassing the spot market completely and signing direct agreements with mining companies. Manufacturers only move this aggressively when they've seen something in the data that the public hasn't. This is still phase 1 of the crisis. Quiet accumulation without panic. The players with information have already positioned themselves. The question that remains is simple. Are you prepared, or are you about to be caught flat-footed? Phase 2 is far more visible and far more disruptive. Export restrictions and capital controls. This is the stage where governments begin protecting their own supply by limiting what leaves their borders. It never starts with panic. It starts with explanations, national security, environmental concerns, industrial strategy. The reasons sound reasonable, but the effect is always the same. Global supply chains fracture, international markets break down, and prices begin drifting out of sync with reality. History has shown this pattern clearly. In 2013, Indonesia, one of the world's largest tin producers, suddenly banned tin exports. Officials said they were simply waiting for price stability. In translation, they were securing domestic supply and giving their own downstream industries and favored partners time to position themselves. Tin prices doubled. Industries that depended on tin struggled to function. The ban eventually ended, but the psychological lesson remained. The world learned that governments could use control of minerals as a geopolitical tool. We saw a louder version of this during the rare earth crisis of 2010. At the time, China controlled 97% of the world's rare earth production. Then, almost overnight, they restricted exports, officially for environmental protection. But behind the scenes, China was rapidly scaling its electric vehicle industry, expanding wind turbine manufacturing, and building advanced missile systems. They needed their own supply, so they choked the rest of the world's access. Prices skyrocketed tenfold in just a year and a half. Japan raced to build emergency reserves. The United States rushed to reopen shuttered mines, only to discover that mining doesn't restart in a matter of months. It takes a decade. By the time new supply came online, the damage to global markets was already done. Now look at silver today, and the same playbook is unfolding in slow motion. Russia began restricting silver exports to sanctioning countries back in 2022. It wasn't a total shutdown, but it was enough to weaken global supply. Mexico, the largest silver producer on Earth, introduced export quotas in late 2024. They didn't ban exports outright, but quotas send a message. Access is no longer guaranteed, and the government is preparing for something. Peru tightened mining regulations shortly after, slowing production at the exact moment global demand hit record highs. Is that coincidence or the beginning of strategic protection? Then things became even more troubling. In February 2025, 4 major South Korean banks stopped selling physical silver. This wasn't because they chose to limit sales. It was because they could no longer source metal. When large financial institutions with vast capital and global connections cannot secure physical supply, it signals that the real metal, not paper contracts, not futures, not derivatives, is already in short supply and being locked away by major players. China added another layer of confirmation by blocking citizens from purchasing precious metals through banks and reclassifying these assets as higher risk. When a government restricts access to metals for its own population, it typically means those metals are being preserved for strategic use. Piece by piece, the global silver market is showing the same cracks that appeared in previous crises. Quiet stockpiling, restricted exports, shrinking availability, and now banking limitations. These are not isolated events. They are the early waves of a supply shock that will become visible to the world only after it is too late to react. Phase 2 is no longer theoretical. It is active, visible, and accelerating. One of the clearest signs is the tightening of access on public platforms. Governments have begun restricting where citizens can buy physical metal, not because they want to control retail speculation, but because the state itself is accumulating. When a government is securing supply for strategic purposes, it does not want its population competing for the same ounces. This marks the heart of Phase 2, fragmentation. Nations turn inward. Domestic supplies prioritized, export channels shut down or slow to a drip. The global market that everyone assumed would always function, always supply, always balance, always correct, begins to break apart under the pressure. And once fragmentation takes hold, Phase 3 becomes unavoidable. Phase 3 is the final stage, price controls and rationing. This is the moment where governments and financial exchanges stop pretending the market is free. It is not a question of if, it is a question of when. Every major resource crisis in modern history has reached this stage, and the early warning signs surrounding silver are flashing in the same familiar pattern. A look back at history makes this clearer. In 1971, foreign governments were demanding physical gold in exchange for U.S. dollars. The United States didn't have enough to honor those claims. So President Nixon closed the gold window, ending convertibility. The price of gold, locked at $35 per ounce for decades, exploded to $850 by 1980. That wasn't normal appreciation. That was the paper system breaking apart. The physical market drifted away from the official price, and those holding real metal, not promises, came out on top. The same thing happened during the Hunt brothers' silver episode in 1980. They accumulated roughly 200 million ounces and demanded physical delivery. As the vaults emptied, the exchange panicked. Instead of letting the market function, They changed the rules overnight. They banned new long positions. They raised margin requirements so sharply that ordinary trading became impossible. They halted trading multiple times. The Hunt brothers were ruined financially. Yet the real lesson wasn't about them. It was about what happened to people holding physical silver. Even when the price collapsed on paper, from around $40 down to $10, those who owned physical metal outright, especially if they bought at lower levels, survived the chaos and, in many cases, profited. Paper markets broke. Physical metal didn't. Then came palladium in 2001. Russia delayed shipments, and suddenly there was no metal available. Futures traders, expecting to take delivery, panicked when they discovered the cupboards were bare. Prices went vertical, hitting $1,000 an ounce, a massive spike at the time. In the end, the exchange forced cash settlement. Traders who thought they owned palladium were given dollars instead of metal, and those dollars bought far less palladium than their contracts had promised. Once again, the people who held physical metal experienced a completely different reality than those holding paper claims. Now compare these historical moments to what is happening with silver today. Registered inventories on COMEX have fallen from roughly 100 million ounces in 2020 to under 40 million now, a stunning 60% decline. Meanwhile, industrial demand consumes about 1 billion ounces per year. That means total visible inventories equal only about 3 weeks of global consumption. Just 3 weeks. If a major manufacturer publicly admits it cannot secure enough silver, panic won't happen slowly. It will cascade instantly. Industrial buyers will rush to secure supply. Governments will scramble to build strategic reserves. Retail investors will flood the market. Meanwhile, the paper market, where over 100 ounces of paper silver trade for every single ounce of physical, will implode under its own weight. Phase 3, when fully active, looks like this. Trading halts become common. COMEX suspends delivery of silver because there isn't enough to fulfill requests. The largest silver ETF, SLV, announces that redemptions will be cash settled due to a lack of physical availability. Investors realize that their shares are not claims to metal. They are claims to dollars, and those dollars will buy far less silver than they did when the investment was made. At that point, the illusion of a functioning market falls apart. Price controls appear. Rationing begins. Governments and exchanges intervene openly because they have no choice. And the only people protected in that moment are the ones who already hold real, physical metal, outside the system that is being rewritten in real time. Governments introduce price controls not to protect the public, but to protect the system. When shortages become undeniable, they freeze or cap prices to calm the headlines and slow the panic. But price caps never fix a supply crisis. They only hide it. The moment official prices stop reflecting real scarcity, a second market forms in the shadows. Physical silver begins trading at 2, 3, even 5 times the official price. Dealers run out of inventory. Mints develop backlogs that stretch a year, then 2. Premiums soar to levels no one once believed possible. $50 over spot, then $80, then $100, because the spot price no longer represents real-world availability. It becomes a number printed on a screen, disconnected from physical metal. This isn't exaggeration. This is the same pattern every commodity crisis follows. The difference now is the magnitude. The signals aren't whispering, they're shouting. The reason silver is different this time is simple. Every past resource crisis had a safety valve, some way to ease the pressure. Oil shortages eventually ended because Saudi Arabia increased production and new oil fields came online. The rare earth crisis eased when countries started developing their own deposits. The semiconductor shortage was relieved when new manufacturing plants were built. But silver has no such escape route. Silver supply is structurally limited. Around 70% of global silver production comes as a byproduct of mining for other metals, like copper, zinc, and lead. That means you cannot simply decide to mine more silver. The only way to increase production is for base metal mines to expand. And with low prices and weak demand in those sectors, miners are cutting investment, not increasing it. Even if they wanted to ramp up, bringing a new mine online takes a decade or longer. The world doesn't have 10 years. The deficit exists today. Recycling won't fill the gap either. Less than 20% of the silver used in electronics is ever recovered. The quantities are too small per device and the extraction too expensive. And solar panels, the single largest new source of demand, lock their silver away for 25 years. Once installed, that silver is effectively removed from the available supply for a generation. Substitution isn't an option. Engineers have tried everything. Copper corrodes, aluminum lacks conductivity, and no synthetic material can match silver's unique electrical properties. You can redesign technologies, but you can't rewrite the periodic table. The industry has tried to reduce silver usage in solar cells for over a decade, but efficiency collapses without it. Silver paste remains the only viable material at scale. And here is the most important part. Demand is mandated by law. The United States, China, and the European Union have committed trillions of dollars to the energy transition. Solar capacity must double by 2030 to meet climate goals. These are legal mandates, not market choices. Governments will not slow these targets because silver gets expensive. Policy doesn't care if silver costs $30, $60, or $150 an ounce. The installations must continue, which means demand is not negotiable. This is why the coming silver crisis is unlike anything in modern history. In the oil crisis of 1973, relief arrived when Saudi Arabia increased production and new reserves were developed. But in the silver crisis of 2025, there is no Saudi Arabia of silver. There is no giant, untapped reserve waiting to be activated. There is no pathway for demand reduction because industries legally cannot stop buying. This is the first major global resource crunch with no structural solution. Only a price adjustment powerful enough to destroy demand and rebalance the system. And that adjustment will not be gentle. It will be violent. Here's what this means for you. This is not a call to panic. It is a call to understand the trajectory already in motion. Phase 1. Silent accumulation is complete. Governments and corporations have already stockpiled. Phase 2. Export restrictions and global fragmentation is happening now. Supply chains are tightening. Access is shrinking. Phase 3 is getting closer, and when it arrives, the market you're familiar with will not function the same way. The paper market, the world of futures contracts, ETFs, digital claims, and promises of delivery, is already running on borrowed time. Once Phase 3 fully activates, the price on the screen won't matter anymore, because you won't be able to buy physical silver at any price. Dealers will be empty. Mints will have wait lists stretching a year or more. Banks will stop selling entirely. And millions of people will be left holding weakening currency, unable to convert it into the one asset that still holds real value. The time to act is before that moment arrives. Not next month, not once the news headlines finally confirm what is happening. By then, premiums will already be sky high. Physical coins and bars will be unavailable. The rush will begin, and you'll be competing with the crowds who ignored the early signs until it was too late. The only position that can survive Phase 3 is physical silver in your possession. Not shares of a silver ETF. Not paper certificates. Not metal stored in someone else's vault. Physical silver that you can hold in your hand where no counterparty can fail, no exchange can change the rules, and no government can quietly settle your claim in cash instead of metal. That is the only form of silver that cannot be frozen, restricted, or redefined when Phase 3 locks in. This isn't financial advice, it's pattern recognition. You've already seen the 3 phases: silent accumulation by governments and corporations, export restrictions that fracture global supply, and then price controls and rationing once the system begins to crack. You've seen the historical examples: oil, rare earths, palladium, gold, and you've seen why silver is different this time. There are no substitutes, no major new mines, and no emergency supply waiting in the wings. The escape routes that existed in past crises simply do not exist here. The lockdown has already begun. Nations are securing what they can. Corporations are hoarding. Most people still have no idea what any of this means. They won't understand until they're staring at empty shelves and unavailable inventory. Don't wait for the crowd. Don't wait for confirmation. When the average person finally realizes what's happening, the opportunity will be gone. You can check all of this yourself. COMEX inventory levels, export restrictions, corporate supply agreements. All of it is publicly available. And once you see it with your own eyes, you'll understand that this moment isn't hype. It's the largest resource lockdown of the modern era. Most people won't prepare. Most people won't act. But the few who recognize the pattern early don't just protect themselves. They end up ahead of everyone else. The clock is ticking. The system's tightening. The window is narrowing. The lockdown has started. The only question left is whether you move before the door closes, or become part of the crowd that wakes up too late.